Welcome. First, we will address why high-income budgets often fail despite substantial salaries. Next, we will uncover the common trap of leftover cash blending into the next month, and how misaligned credit card cycles amplify confusion. Then, we will outline 2 proven paths to financial control. And finally, we will implement automation and account separation so your money gets a job the moment it lands. Here is our agenda. First, we will define the problem. Next, we will present the controversial truth. Then, we will walk through 2 paths to regain control. After that, we will implement automation and separation. Then, we will fix credit card handling. Finally, we will give you a practical action plan and a quick quiz. In this section, we explain that earning a high income does not prevent financial disorganization. The most common trap is allowing $3,000 to $4,000 to accumulate in checking. This blurs the line between savings and next month's spending needs. When credit card cycles do not align with your pay schedule, the confusion compounds and creates money anxiety. These symptoms indicate your budget is not functioning. First, you cannot explain where several $1,000s disappeared. Second, your checking balance fluctuates significantly and then drains without clarity. Third, credit card purchases are not tracked by category, creating a disconnect between spending and the budget. Fourth, you find yourself making mid-month changes to cover gaps. Finally, savings only occur as an afterthought rather than being prioritized first. Before we proceed, this content is educational and not financial advice. You should consult a licensed financial professional for advice tailored to your specific circumstances. We have 2 primary strategies. First, zero-based budgeting assigns every incoming dollar to a specific purpose before the month begins and requires categorizing credit card transactions at the time of purchase by category rather than focusing on the payment date. This is ideal for people who lose track. Second, the savings first or reverse approach automates at least 15 to 20% of gross income to savings and investments immediately on payday. This treats savings as a fixed bill, paid first, and is suitable for already disciplined spenders who need a simple cap on their spending. To set up zero-based budgeting, first select a budgeting tool that enforces the concept. Next, enter your expected income and pre-assign every dollar to a category before the month begins. Then, build realistic categories, including essentials, variable spending, debt payments, sinking funds, and investments. As you use your credit card, record each transaction in the corresponding category immediately. Reconcile your budget weekly by adjusting categories as needed while maintaining the core plan. Set a false floor in your checking account, such as $2,000, that you never spend below. Finally, schedule automatic credit card payments to pay the statement balance in full on the due date. This flowchart shows the zero-based budgeting process. Income lands in checking. Before the month begins, every dollar is assigned a job across categories. During the month, each purchase, especially credit card purchases, is tracked in the appropriate category at the time of spending rather than focusing on the payment date. Category balances are monitored in real time. At month's end, any amount above the false floor in checking is swept into savings or investments. Additionally, a scheduled action automatically pays the statement balance on the due date. For the reverse or savings first method, choose a target rate of at least 15 to 20% of gross income. Set an automatic transfer from your paycheck to a high-yield savings account or investment account immediately on payday. Set fixed bills to autopay from checking. Maintain a buffer or false floor such as $2,000 in checking. Spend from what remains. The cap is enforced by the automatic transfer. Review monthly and increase the savings rate as your comfort grows. This mind map centers on payday and branches to key destinations. Checking holds a false floor of $2,000 and automatically sweeps excess to a high-yield savings account. Savings and investments include HYSA and brokerage or retirement accounts. Bills include major fixed expenses like housing, utilities, and insurance. Spending encompasses groceries, dining, and discretionary categories. Credit cards are managed by categorizing purchases at the time of spending and setting automatic payment of the statement balance on the due date, optionally aligning the due date with the pay cycle. This sequence diagram demonstrates the flow of funds. The employer deposits income into checking. Immediately, a percentage of the income transfers to savings or investments. Fixed bills are automatically paid from checking. Credit card purchases are categorized by budget category as they occur. On the due date, the statement balance is automatically paid from checking. This maintains clarity and prevents leftover funds from blending into the next month. This table illustrates an example plan. Net income into checking is $10,000. $2,000 automatically transfers to savings or investments on payday. Housing and utilities are $2,500 and auto-paid. Insurance and health are $600. Groceries are $700. Dining and entertainment are $600. Transportation is $500. Sinking funds are $600. And miscellaneous is $400. The credit card payment line shows 0 because spending has already been captured in categories, and the statement balance is auto-paid on the due date. The checking false floor is $2,000, which should never be spent below. Any excess above the floor at month's end is swept to savings. To use credit cards effectively, always budget by category at the moment of purchase instead of basing your plan on the payment date. Set automatic payment of the statement balance in full on the due date. You can request that issuers shift the due date to align with your pay cycle if it helps with cash flow. Keep your utilization low and avoid carrying balances. Quiz time. The question is, what prevents leftover money from blending into next month's spending the most effectively? The options are A. Tracking the payment date of your credit card. B. Keeping all money in one checking account. C. Setting a false floor and auto-transferring savings above it. D. Paying the current balance every few days. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. Establishing a false floor provides a minimum balance you never cross, and automation removes excess to savings or investments, preventing accidental rollovers into the next month. These are the key points. If you cannot account for large sums, you are not truly budgeting. Choose zero-based budgeting for maximum clarity or savings first for simplicity. Automate transfers and maintain separate accounts. Use a checking false floor and sweep excess above it to savings or investments. Track credit card purchases by category and auto-pay the statement balance. To conclude, here is your action plan. First, choose zero-based budgeting or the savings first method. Second, set a savings rate of at least 15 to 20%. Third, build your budget categories. Fourth, create a $2,000 false floor in checking. Fifth, automate transfers and bill payments. Sixth, track credit card purchases by category and auto-pay the statement balance. Seventh, review weekly and sweep any excess to high-yield savings or investments. Thank you for watching. As we wrap up, please like this video, share it with a friend who needs it, and subscribe for more practical money systems. Share your wins and questions in the comments so we can continue the conversation and help you build sustainable wealth.